What's up, my trading friends? I'm back with another video about trading, and this particular one is about a special situation in options. I think it's a pretty good one, so sit back and relax and let's check it out. All right, so I was looking through my Facebook account and I found this trade. It was posted by a cool person from our forum on Facebook. We have a couple forums, but one of them is about options. The other one is about the VIX. So this one about options, let's just take a look at this question and we can go over it together. This was supposedly a risk-free trade, and here's Min here talking about this risk-free trade. And it says, a guy does a box trade on UVXY expiring in the year 2021. Then one of his legs gets partially assigned. Trader says he had no money at risk, then promptly loses almost 2,000%. Okay, so I've talked about box trades before when we were talking about spreads and how a call spread is kind of like a put spread. And box trades are most familiar to people that trade indexes. If you're a floor trader in an index, you would definitely know about boxes because you're always trying to relate one option to another. And if you buy a call and sell a put on one strike and then sell a call and buy a put on another strike, that completes a box. You've got a long call spread and a short put spread together. You're essentially buying the underlying synthetically in one strike and selling it synthetically in another strike, and it should all cancel out. Now, this guy put this trade on in UVXY, and when he looked at the prices, he saw that if he put this box on, it didn't all add up to nothing. In fact, it added all up to him making a lot of money. So this, first of all, violates the first rule of trading for an options trader, which is when you see something that seems too good to be true, you need to ask yourself, why am I so lucky? Was it just that the market just wanted to give me this money, nobody else figured it out, and they just left some money out there for me to pick up? And if you had thought to yourself, what makes me so lucky that someone just wants to give me money, then you probably would have researched further before you put this trade on. Another very important aspect of this particular situation is something that is shared between UVXY, which the trade was put on, and Tilray. And what do UVXY and Tilray, a Canadian MJ stock, have in common? Well, if I pull UVXY up here, I'll give you a hint. If we look over to the side, and it looks like, looks like there's some glare coming off of the screen here, You can't see a little bit because there's glare. That's pretty amazing. Let me see if I can get rid of that. Okay, there we go. If you look on the screen here, we find that UVXY is hard to borrow. Okay, and so that means people are always trying to get the stock in any way they can. A lot of times in a hard to borrow stock, somebody, if you're trading in a pit, would quote the reversal conversion market. What is a reversal conversion? That is a situation where you are quoting to buy in one trade, buy a stock, sell a call, and buy a put. So you're converting stock into a long call short put, or vice versa. And normally in a stock, the reversal conversion would be just the cost of carry for the time until those options expire. However, in a hard to borrow stock, people will pay a premium to get that long stock. Those of you who are maybe in the TD Ameritrade hard to borrow program or have some experience with hard to borrow issues know that you need to pay a certain percentage interest rate above and beyond a normal interest rate to borrow stock to short it in a hard to borrow situation. And indeed, when there's a deal stock where there is an arbitrage going on where people need a lot of the stock, people will actually come in and quote the reversal conversion, and they will pay up for it. And so in a hard to borrow issue, it's going to take the box out of whack. Now, there's some other things with deal stocks that will take the box out of whack. For example, a two-tier takeover would very much affect the box. And there's other risks of takeovers, but I'm not going to go into two-tier takeovers today. Let's stick to this UVXY example. Now, anytime you sell an option, you have a risk on of being assigned. And this is because selling, it's just based on the definition of an option. If you sell a call, even if it's part of a spread, you are giving somebody the right, but not the obligation, to exercise that call and to receive 100 shares, well, in normal options, 100 shares of the underlying for every call that they're long. And usually, you don't have to worry about being assigned on a call unless there's something like a dividend coming up or the call is very deep in the money, because usually there is some intrinsic value, or I'm sorry, there's some extrinsic value above and beyond the price of the call. So, for example, if you have a $10 stock, the five-strike call will be worth more than $5. It will be worth $5 plus whatever that 5 put is worth, and therefore, usually you won't get assigned on a call because that would be like as if you think of a call as a synthetic put, you're getting to buy back. If you get assigned on a call, you're essentially getting to buy back a put that has some value for free. So usually you don't get assigned on calls. But in a case of a hard to borrow issue, people want that long stock. And so if the value of the call, if it's intrinsic plus extrinsic value is low enough that people are willing to pay that to get long stock, they will exercise their calls on you. And unfortunately, the person that was trading with Robinhood didn't understand what his risks were. In a hard to borrow issue, if you're short stock, you risk getting bought in. And if you're short options, you risk getting assigned on those options, either deep calls or deep puts. And in a case of something that's very far out in time, there is an interest rate component going on there as well. So the most important thing to take away from this is, A, if something seems too good to be true, you're probably doing something wrong, because nobody on Wall Street just leaves free money for you to pick up, or it's very, very rare. And I would consult an expert before you put on some big trade that you think you're a genius on and that you've seen something that nobody else has. The other thing with a trade that's that far out in time, it's a couple years out in time, is that money is going to be locked up for a long period of time. So you have to really, even if it's a decent amount of money that you're getting, if it's going to take 2 years to come in, then you might want to reconsider doing that trade. It's not surprising to me that Robinhood would not have the risk management in place to disallow this trade immediately, or to at least require somebody to put up a lot more margin than was for that trade. But options can be confusing, and the simplest way to start with options is to buy them, because you can't get assigned on any option you own. You're holding all the cards if you own an option. When you're selling an option, don't give them away for too cheap, because you're giving control of 100 shares to someone else. Now, I could go into more detail on this trade if you want to get more into the nuts and bolts, but those are the basic concepts to take away from this. A hard to borrow issue is going to throw a wrench in the reversal conversion market, and the relationship between buying a call and selling a put and buying the underlying is going to move because the underlying is very hard to get. So that becomes more valuable than owning a call. If owning a call and owning the underlying used to be of equal value, now all of a sudden the underlying is of higher value. So keep that in mind. I'm going to be switching to a newer format with a little bit smoother type format going forward. Let me know what you think of it. And let me know what you think of some of this music, and I'll catch you in the next one. Bye now.